Essar Oil recently declared its results for the June quarter. India's second biggest private refinery reported its highest ever gross quarterly revenues at Rs 22,109 crore for Q1 FY13, up 34% from the corresponding quarter last year. The jump is due to higher product price realization on account of increased domestic sales and rupee depreciation. Essar Oil is now firmly on track to hit a revenue landmark of Rs 1 lakh crore this fiscal. The share of heavy and ultra-heavy crude processed during the quarter was 89% against 66% in Q1 FY12. Similarly, valuable light and middle distillates share in the overall crude slate in Q1 FY13 was 83% against 73% in Q1 FY12. For the quarter, the current price gross refinery margin was $4.69 per barrel compared to $4.20 per barrel in Q1 FY12. Essar Oil reported upswing in GRMs in spite of benchmarks IEA Singapore margin contracting by $1.8 billion during the quarter, indicating improvement of margin post completion of refinery expansion project. The full benefit of higher complexity, stabilizing of units and captive coal-fired power plant will be felt from the current quarter onwards. Essar Oil's GRMs are expected to be $7 to $8 higher than benchmark IEA margins.
We have completed a very eventful, satisfying and yet a very challenging quarter. We have recorded a turnover of about 22,000 crores. We have had a throughput of about 4.5 million tons, which now reflects our enhanced capacity of 18 million tons. On the financial side, the crude prices during this quarter has taken a severe beating, almost $30 downfall from the beginning, and this has impacted the results of all the refining companies, and we were also impacted severely because of this. So our net profit is actually a net loss figure for this quarter at 1400 crores as against a small profit in the corresponding quarter.
Key highlights: all new units of refinery expansion and optimization stabilized and refinery will now operate at over 20 mmTPA capacity. Benefit of higher complexity begins to get reflected. Full margin benefit of approx $7 to $8 billion over IEA will start getting reflected from the next quarter onwards. Highest ever quarterly revenue in Q1 FY13, up 34% to 22,109 crore as compared to 16,478 crore in Q1 FY12. Vadna Refinery received the Refinery of the Year award from the Petroleum Federation of India. Essar Oil has also received an approval for the exit of its corporate debt restructuring loan facility. The facility, which facilitated the construction of Vadna Refinery, was set up in December 2004 and will be replaced with the new debt facility of about Rs 9,400 crore. The exit will assist in the company enjoying greater operational and financial flexibility.
CDR exit, a very landmark achievement. We have been waiting for the last 2 years. Why it is landmark? Because it provides a lot of flexibility both in terms of operational as well as financials. In terms of operational, when we are in CDR, there are a lot of requirements which we have to comply with, like trust and retention account. There is a mechanism how we can retire our liabilities. There are nominees. There are restriction on our capex, restriction on the board, restriction on the dividend payment. With the CDR exit, these flexibility will come now, and we will be able to have some of the like capex, dividend, nominees. Some relaxation will be going to have after the CDR exit. My revenue is in US dollar, whereas my loans today are in rupee. So there is a mismatch. In case of appreciation of rupee, while I will get a lower realization, my liability remains same. Of course, I am going to get benefit in case of depreciation of the rupee. But as our aim is to immune the business from this volatility, our intention is to move our loan basket from rupee to dollar so that we have a natural hedge we have a hedge in terms of GRM, and this volatility of rupee will not impact my business and protect my bottom line.